Hello everyone, and welcome back to Collin Investing, your go-to channel for in-depth analysis of financial news and investment opportunities. Today, we have a lot to unpack, from record-breaking gold prices to some major stock market moves, and the ever-evolving landscape of U.S. economic policy. I will provide my insights and analysis of those events. So, let us dive in. In the introduction, I mentioned that we are going to talk about gold. So let's start with the shining star of the commodities market, gold. It has recently smashed through historical highs, and many are interpreting the surge as a direct response to the looming threat of a global trade war, largely fueled by Trump's aggressive tariff policies. Think about it. Increased tariffs often equals increased uncertainty. Investors naturally get spooked. But the story of gold is far more fascinating to me than just a knee-jerk reaction to current events. If you look back, all the way back to the year 2000, gold's cumulative increase is almost a staggering 1,000%. Other asset classes are just not in that picture. This isn't just a blip. We are not talking about short-term volatility here. We're talking about 2.5 decades of sustained growth, firmly positioning gold. Gold is not just a precious metal anymore. It is something we need to protect against economic instability, an asylum. It is becoming a fundamental measure of true wealth in a world that feels, at times, increasingly uncertain. Consider a situation where you are in a global conflict. Gold would be your best friend. Building on that point about gold's perceived safety, this brings us to a fascinating and frankly somewhat unsettling story developing around Fort Knox. As you may know, it's the US's largest and the world's largest gold vault. Trump has stated that he wants to personally visit Fort Knox, his stated reason, to ensure the gold reserves are actually there. And everything's, to put it, intact. Now you might be thinking, why the sudden concern? Well, let's take a step back. Fort Knox, this legendary vault, isn't just some recent creation. Its roots trace back to the Great Depression, established in the 1930s to store a significant portion of the gold. In current measure, that's a staggering 56% of the U.S.'s total official gold reserves, which is around 8,133 tons. That's a lot of gold. And that's where the intrigue really begins. Public concern, and maybe a bit of healthy skepticism about the actual state of those reserves has been brewing. Imagine that you are holding a large gold reserve and no audit has been done for a while. It's just natural to have skepticism. The last truly comprehensive audit of Fort Knox, all the way back in 1974. There have been some visits since, notably in 2017, but here is the core issue. They were primarily visual inspections. No one was rigorously checking the purity, the actual gold content of those bars. It's a bit like looking at a locked safe and assuming it's full of valuables without actually checking the contents. That might be okay, but it's good to make sure. And that's where it gets even more interesting. And, to be honest, a little concerning for some. Remember that key concept from the previous slide about Fort Knox being the U.S. largest gold vault? We talked about skepticism. Well, it plays directly into this slide. I have read reports, and so many people are saying perhaps the actual specific location of some, or maybe even much, of that gold within Fort Knox isn't widely known within the U.S. government itself. Some reports go as far as saying it's a closely guarded secret, known only to specific very powerful Jewish connots. In short, top secret. Now, I am not here to endorse any conspiracy. That's not the purpose of this channel. But it is important to understand the levels of speculation, the whispers that surround something as fundamental as a nation's gold reserves. It decodes the inherent trust, and sometimes the lack thereof, in these massive financial systems. But wait, there is more. It is not only U.S.'s gold. It's not just the U.S. that stores gold in Fort Knox, or, more broadly, within the U.S. Many other countries, for reasons of convenience, security, and historical precedent, also keep a significant portion of their gold reserves within American vaults. It's a bit like a global safety deposit box system. It worked for many years. However, here has been growing unease. There have been rumors circulating for a while now about gold disappearing, perhaps not being where it's supposed to be. Some countries, famously Germany in recent years, have even started repatriating their gold, bringing it back home, though that process itself has proven complex and slow. Think about this situation and what it means. So many countries are using a safety box, and there are rumors about it. What would you do? So, what happens if these rumors, these whispers about the gold reserves turn out to have any truth to them? What are the potential implications? The answer, frankly, is quite alarming, and it has several layers. First, and perhaps most devastatingly, it would trigger a massive credit crisis. We're not just talking about a dip in the market, we're talking about a fundamental shattering of trust. U.S. government credibility, the bedrock upon which so much of the global financial system rests, would be severely damaged. This would directly impact the perceived value of U.S. national debt, and by extension, the U.S. dollar itself. It's a domino effect of potentially catastrophic proportions. Secondly, imagine the global reaction. Every nation that stores gold within the U.S., and potentially even those that don't, would almost certainly demand thorough independent audits of their reserves. This isn't just about the U.S. anymore. It's about the stability of the entire global financial system. This rush for verification, this understandable panic, could create immense volatility in asset markets worldwide and not just in gold. Think about ripple effect. And thirdly, a purely practical, yet incredibly significant point. If there are shortages, if gold is missing, the U.S. government, or those responsible, would likely need to repurchase significant amounts of gold on the open market to cover those gaps. Basic supply and demand tells us what happens then, right? The price of gold would in all likelihood skyrocket, further exacerbating the existing crisis. It is not just a financial issue, it is a scale deal one. This is a very serious situation. Let's analyze the other news. This leads us to an interesting paradox and a significant shift in the broader U.S. political and economic landscape. We've been talking about gold, global finance, and potential instability, but what's happening within? The U.S. is equally, if not more, Apple right now. Trump's policies, and I mean this across the board trade, domestic reforms, his approach to international affairs are, to put it mildly, reshaping the global order. We are having a chain effect here starting from gold and, love him or hate him, you can't deny the ripple effects. It's causing a level of economic uncertainty that we haven't seen in quite some time. I was talking to a CEO last week who said his main issue is planning the future. He said, I can't plan for next 6 months. Take, for example, the news coming out about the IRS, the Internal Revenue Service. There are reports of massive staff cuts, around 6,000 employees, and even more drastically discussions, apparently driven by Trump, to abolish the IRS entirely. The proposed replacement, a so-called foreign tax bureau. The idea, as it's being presented, is to shift the tax burden away from American citizens and onto foreign entities. Now, I will let you think about it. Let's take another point. The global perception of the U.S. While we talk a lot about the impact in U.S., the perception is very important too. Recent surveys, particularly in Europe and Canada, show a growing negative sentiment towards the U.S. We're seeing words like enemy being used in some polls, which frankly is a shocking development in traditionally strong alliances. But here is the twist, the interesting paradox. Domestically within the U.S., Trump's approval ratings are reportedly rising. This divergence, this disconnect between international perception and domestic support, is a critical factor to watch. It suggests a potential for increased internal focus, perhaps at the expense of international cooperation, and that has profound implications for everything we've discussed, from trade wars to the stability of global markets. With that in mind, let's examine potential financial relief and the political moves, and that's where Dodge comes in potentially. Here is talk, and it's significant talk, of a massive $400 billion dividend distribution from Dodge. Combined with this, there is a consideration of a $5,000 tax refund directly to American families. We, as people following economy, know that this is a huge amount. Now, you might be wondering, why now? What's the driving force behind these frankly very generous proposals? Well, consider the timing. We're approaching the midterm elections. It is not a secret, and the timing of any such financial relief, whether it's the dividend distribution or the tax refunds, could be, let's say, strategically aligned with that electoral calendar. It is politics. Imagine that. You are struggling with several issues, bills, etc., and you receive a $5,000 check from government. How would you feel? What would be your reaction? These kind of moves, injecting cash directly into the hands of consumers, can have a significant, albeit potentially temporary, impact on the economy and, of course, on voter sentiment. This is a crucial point to consider and to interpret what it means for the future. Let's turn our attention now to the stock market, and specifically a company that's been making waves and recently some rather concerning dips. Palantir or PLTR. The stock price has taken a beating, plunging over 20% from its recent high, and there are two primary culprits being blamed: defense budget cuts and the CEO selling off some of his stock. Now, you might be thinking, that sounds bad. And it's true, but it is not the full story. Let us analyze them. For those less familiar with Palantir, let's quickly recap what they actually do. At its core, Palantir provides AI-powered data analysis platforms. Think of it as giving businesses and government agencies a super-powered magnifying glass to examine their own data, helping them make better decisions, improve efficiency, that sort of thing. So how do those defense cuts fit in? Well, the concern is obvious. A significant chunk of Palantir's revenue comes from government contracts. However, here is a counterpoint to consider. Budget cuts often force organizations to become more efficient, to do more with less, and that's precisely where Palantir's technology shines. I think increased efficiency might actually benefit PLTR in the long run as agencies scramble to optimize their operations. It's a bit of a paradoxical situation. The other factor, the CEO selling stock, always raises eyebrows. It's natural to wonder, does he know something we don't? But, and this is key, reports indicate he actually reduced the scale of his planned stock sale. It's still a sale, yes, but a smaller one. In my years of analyzing these kinds of situations, this could actually signal a degree of underlying confidence, a belief that holding on to more of the stock is still a worthwhile bet. Building on that point about stock market, Palantir is not the only one. Let's talk about a different stock now. Let's shift our focus overseas to a company that's been showing some serious signs of life. Alibaba, the Chinese e-gun giant. The stock has been on an absolute tear, surging over 60% since the beginning of the year. That's a remarkable comeback. And there are two main drivers: the recent, very strong earnings report, and perhaps even more importantly, a perceived easing of political risks in China. It is very important for Chinese stocks. Let's break down the numbers. In the fourth quarter, Alibaba reported revenue of 280.15 billion RMB. That's an 8% increase year-over-year, and it beat analyst expectations. But the real headline grabber was the net profit, a staggering 46.434 billion RMB, up a whopping 333% year-over-year, I mean. That's the kind of growth that gets investors very excited. One of the key areas to watch with Alibaba is its cloud business, and that segment delivered strong growth, up 13% year-over-year. And the company is clearly doubling down on AI investments, recognizing that's where the future lies. But perhaps the biggest news, the thing that really signaled a potential shift, was Jack Ma, Alibaba's founder, participating in a Chinese government meeting with other entrepreneurs. For those who've been following the Alibaba saga, you know that Ma's relationship with the government has been, shall we say, complicated in recent years. His presence at this meeting is being widely interpreted as a sign of improved relations, a thawing of tensions, and that's a huge relief for investors who've been worried about the regulatory crackdown on Chinese tech companies. But that's not the whole story, of course. We've seen this incredible surge, fueled by positive earnings and a shift in the political winds. So, the critical question becomes, can Alibaba sustain this momentum? Can they keep this up? While the political risks have certainly decreased, and that's a big deal, it's crucial to remember they haven't disappeared entirely. The regulatory environment in China is still, let's say, evolving. It is not like US, and, more broadly, while the Chinese economy is showing signs of recovery, its long-term economic certainty, at least in my view, isn't quite as great as what we see in the US. There are still structural challenges, debt concerns, and demographic shifts to consider. I want to be clear, I'm not saying Alibaba is a bad investment, not at all. I maintain a previously stated point of view. I believe TIR is absolutely an opportunity. Here a chance for both value and sentiment repair. We're seeing that play out right now. Investors are feeling more confident. The stock is reflecting that, but, and this is a significant but, I still have reservations about declaring a full-blown, long-term bull market for Alibaba, or for Chinese stocks in general. We need to see more consistent policy, more sustained economic growth, before I'd be completely comfortable with that call. It's a situation to watch closely, to be cautiously optimistic, but also to be aware of the potential headwinds that still exist. It is good improvement, but let's wait and see. Now let's talk about another giant, but this time in the retail space, Walmart, and their stock price tells a bit of a different story. At least initially, Walmart stock actually dropped 6.5% after they released their earnings, even though, and this is key, they beat expectations for the fourth quarter. So you have a situation. So what's going on here? It's all about the outlook. the guidance they provided for future profits. It was, to put it mildly, weaker than what the market was hoping for. Let us check the core numbers. Q4 revenue came in at $180.6 billion. That's a 4.1% increase year over year and slightly above what analysts had predicted. And importantly, U.S. same-store sales, a critical measure of retail health, were up a solid 4.6%. So, on the surface, things look pretty good, right? But the market is forward-looking, always. The issue lies in the lower profit guidance that Walmart issued, both for the upcoming quarter and for the full year. Now, the company attributed this to a few factors. The impact of a leap year, which adds an extra day of expenses. There are also recent acquisitions they've made, and the fact that there was a consumer stimulus program in Mexico last year that boosted sales, making the comparison tougher this year. It is not an easy task to analyze all these. They provided some details, so we will see. Walmart's management hinted at conservative estimates, and this is something we've seen before. In the past, their initial guidance has often been exceeded. They've actually performed better than what they initially projected. So it is good to keep that in mind, however, and this is a crucial point. There are some legitimate concerns, things that investors should be aware of. Firstly, here is the valuation. Walmart, despite being a retailer, is trading at a relatively high valuation, around 37 times its forward price-to-earnings ratio. That's getting into territory usually reserved for high-growth tech companies, not necessarily a traditional retailer. And it implies a lot of optimism is already baked into the price. Secondly, we have to consider the broader economic context. Over the past couple of years, Walmart actually benefited from higher interest rates, believe it or not. Higher income consumers, feeling the pinch, started trading down, shopping at Walmart more often to save money. But as interest rates potentially decrease, that trend might reverse. Those same consumers might feel more comfortable spending at higher-end stores again. This is what we call a headwind. And finally, the elephant in the room, Trump's proposed tariff policies. We talked about gold and uncertainty earlier, and it's related here too. If those tariffs go into effect, Walmart, which relies heavily on imported goods, could face significant cost increases. They can try to pass those costs on to consumers, but that could hurt sales. So here is a delicate balance. It's a bit of a mixed bag, really. On one hand, you have a company with a proven track record, a dominant market position, and they're actually making some very smart moves with AI. Let's give some credit here. For example, they're using AI agents to help their merchants with things like inventory management, identifying problems more quickly. They're also using AI to help their developers write code faster and more efficiently. These are real, tangible examples of how a traditional company can leverage AI to improve its bottom line. But on the other hand, you have these valuation concerns, the potential shift in consumer behavior, and the looming threat of tariffs. So it's a situation that requires careful consideration. It is not as easy as saying good or bad. Long-term value, absolutely, it's Walmart. Short-term risks, definitely something to keep in mind. Let's check another stock. Let's continue this market discussion, shifting gears from retail to the tech world, and that's where Alphabet, Google's parent company, comes in. I want to highlight 3 key areas that I believe every Alphabet investor or anyone considering investing should really be aware of. First up, let's talk about Google Cloud. This is where a lot of the future growth potential lies. In 2024, they reported that first-time commitments to their cloud services more than doubled compared to the previous year. That's a huge jump, indicating strong adoption and trust in their platform, and it's not just new customers, existing ones are spending more, deepening their relationships with Google Cloud. Hello everyone, and welcome back to Collin Investing. Alphabet is also very clear. They're pouring resources into this segment, specifically for artificial intelligence. This is a critical point. AI is the future, and Google is positioning itself as a leader. Secondly, let's talk about YouTube. We all know YouTube, right? But you might not realize just how dominant it's become in the streaming world. Nielsen data shows that YouTube is #1 in streaming watch time in the US. I use YouTube almost every day, and I am subscribed to premium version because I find many things I like in YouTube. The platform is simply massive with over 2 billion monthly active users. That scale creates a network effect that's very hard for competitors to break into. Finally, let's touch on Waymo, Alphabet's self-driving car division. Last year, Waymo served over 4 million passenger trips, and they're now averaging over 150,000 trips every week. That's real-world usage, not just testing, and they're expanding with plans to launch in Austin, Atlanta, Miami, and even internationally in Tokyo. While it is not as big as other divisions, there is a lot of potential here. I think Alphabet is making great moves. We will see. We have been checking several stocks, their ups and downs. From established names like Walmart and Alphabet, let us check a different company. Let's turn our attention to a much more speculative but potentially revolutionary investment. IonQ, a company at the forefront of the quantum computing race. Now, the stock performance has been, let's say, a roller coaster. It is down 18% so far this year in 2025, and that might scare some people off. But zoom out a bit. Over the past year, IonQ's stock is up a staggering 215%. That's the kind of volatility you have to expect with a company in such a nascent cutting-edge field. It is not for the people who are looking for stable investments. When we talk about quantum computing, we're talking about a technology that's still in its very early stages, but with the potential to completely transform industries, from medicine to materials science to finance itself. IonQ is considered one of the leading pure-play quantum computing stocks. What does that mean? It means their primary focus, their entire reason for existing, is to develop and commercialize this technology. And in that very niche world, they're actually generating some revenue. Their trailing 12-month revenue is $37.5 million. Now, that's a tiny number compared to the giants we've been discussing. But in the quantum computing realm, it's significant. It shows they're not just a research project, they're actually starting to commercialize their technology. But, and this is the critical point, it's a high-risk, high-reward situation. IonQ is unsurprisingly unprofitable at this stage. It takes enormous investment to develop this kind of technology. However, if this is successful, imagine that it will change our world. The potential for massive growth is absolutely there, but the flip side is also true. The risk of significant losses is very real. And because the industry is so new, so uncertain, traditional valuation metrics, the things we use to assess more established companies, they become incredibly difficult to apply. It's like trying to predict the future of the internet in the early 1990s. You can guess, you can make projections, but here is a huge margin for error. I would not recommend this for new investors. You need experience to calculate risk and benefits here. So, considering all of this high risk, high reward, nascent industry, the question is, should you buy IonQ's stock before they release their earnings? My recommendation is, no, I don't see a compelling reason to rush in before the earnings announcement. And here's why. Companies like IonQ, operating at the absolute bleeding edge of technology, they don't tend to wait for a scheduled earnings call to announce major breakthroughs. If they achieve something significant, a new milestone, a technological leap, they're going to want to shout it from the rooftops immediately. Why? Because it validates their work. It attracts further investment. It boosts their stock price. They're not going to hold back that kind of news for a potentially mundane earnings report. So the probability of some game-changing announcement being tucked away in the earnings release is, in my opinion, relatively low. It is unlike other stable big companies. A good time, potentially a better time, to consider buying IonQ, or at least to reassess your position, might be after the earnings release. You'll have the latest financial data, you'll hear management's commentary, their outlook, and you can make a more informed decision. Remember, this is a volatile stock. In a volatile sector, patience and informed decision-making are your best allies here. We will continue our analysis in the next section. Stay tuned. We have covered a lot of ground today, from the complexities of the global gold market to the volatile world of individual stocks and the evolving economic policies. I tried to combine all of them to give you a big picture of what's going on in the markets. We checked established names and also newcomers, their ups and downs. So, what is the conclusion? I want to emphasize that the information presented in this video should not be taken as direct financial advice. This is an educational and analytical video, and you must do your research before the investments. If you found this deep dive into the financial world valuable, please show your support. Like this video. It helps the channel grow and reach more people interested in understanding these complex issues. Subscribe for more finance and investment content. We're constantly analyzing market trends, breaking down economic news, and exploring investment opportunities. Your engagement truly makes a difference. And finally, I'd love to hear from you. Leave a comment below with your thoughts, questions, your own takes on the topics we discussed. What are your biggest concerns in investment? Did anything surprise you? Let's start a conversation. I'm always learning, and your perspectives are incredibly valuable. Until next time, keep researching, stay informed, and I look forward to exploring the ever-changing financial landscape with you again soon. Thank you for watching Collin Investing.